Hey, welcome to another episode of FinSights. My name is Justin. I have my colleague Jake on the line with me tonight. And as you can see, we have markets in turmoil. It's just a little joke I wanted to play because it seems like every time this picture comes up on CNBC, we have a pretty mega reversal and rally. But as we go to the futures, as you can see in this box over here, we are down almost 4.5% in S&P 500 futures, Nasdaq futures. The VIX is up past 40 again. And the big thing I wanted to talk about tonight is oil. Oil is down over 20% tonight. A lot of that has to do with Saudis cutting their prices on oil, and we will get to that in just a minute. But the next thing I want to show you is the Fear Greed Index. The Fear Greed Index kind of gauges the fear in the market based on puts and calls and a few other ways they decide to calculate this. But as you can see, if we scroll to the bottom down here, we can see that we are at a point that we were at the end of 2018. If you know, back in 2018, this marked a bottom. I'm not saying we're at a bottom yet, but I do believe that this is an extreme sell-off that is bound for some kind of bounce. Now, before we get into when we're going to bounce, we are going to just read some of these headlines here. But as you can see, we have extreme fear, and it is good to be somewhat contrarian. All right, so as we look at these headlines here, we see stock futures fall as crude oil prices plunge 20% on price war fears. And that is what Saudi Arabia and Russia are doing. They're kind of having an OPEC price war, and Saudi Arabia is trying to price Russia out of the oil industry altogether. So that could take crude much lower. When we get into the charts, we're going to take a look and see where we might end up with that. And then the other thing is obviously the coronavirus. Today is March 8th. It's a Sunday night. I've got my casual clothes on tonight. But I want to do a weekly preview. Sometimes it'll be typed. Sometimes it'll be a video like this. And I just think it's good that we created a video because of how the market is right now. And let's go back to the futures here, and we can see, we're down 130 points almost in the S&P 500, and that's going to be a pretty wicked open if that remains. So it's something to be cognizant of as we go into Monday. All right, so as we go into the first chart here, I've got my S&P 500 weekly. I've kind of drawn a simulated candlestick, so this is not actually there. So as you can see, I can kind of move it away, and it's just a simulated candlestick, so don't think that this is an actual price movement. But this is kind of what we're thinking could happen. Ignore these arrows here just for now. We think that the 2700 area is where we are going to find any sort of bounce if we do continue straight down. We do know that we have some demand here in the 2850 to 2900 level. There's a lot of buying that came in at the end of the week last week. As we can see on our chart here, I'm going to go ahead and delete that now that you know that is a simulated candlestick. And I'm going to point at this volume bar here. So there was a lot of buying that came in near the 2900 level. Obviously, that was before Saudi Arabia made the oil cuts. And as you might know, that the coronavirus has grown exponentially around the world. We are now up to over 400 cases in the U.S. the last time I looked. Jake, I don't know if you've looked at that, if you want to comment on that at all.
Yeah, it's starting to get a little scary now. Well,
Yeah, I wouldn't say scary as far as I'm not worried about being sick necessarily, but I do think economic implications are definitely something to be concerned about. So that is why I had that second arrow drawn here. And so what I think might happen is this is our long-term trend line. I will pull up a longer-term weekly chart so you can see that. But right now, this is where demand has held since 2009, since we hit that 666 bottom in the S&P 500 in 2009. And ironically enough, that was on March 6th, 2009 when that happened. It's March 8th, 2020 right now. So I mean, there's nothing significant about that. It's just interesting to me. But as you can see, we drew this kind of makeshift candlestick here. We believe price action could go straight down to this 2,700 level this week. Especially with the news that's coming out, people could panic sell and we could get a push down there before we see a bounce. However, let's go ahead and remove this candlestick so you don't get any, I guess, preconceived notions that is going to happen. One thing we have been looking at is with where the price is going to open, somewhere around where this arrow is starting, around this 2,800 level. We could see a bounce up to the bottom of this trend line before we head down. But the area we really want to pay attention to for longs is the 2,700 level, maybe up to the 2,750 level. And then again, as we're looking at our technical indicators, our weekly stochastics is still not quite oversold, so we still have some room to go down. And that is why we think that the 2,700 level is the area to look at. Now, we could shoot straight down to the 2,600 level. That depends on how volatile things get this week. But right now, we're looking to open down. Let's go back to that chart here. 4.5% on the open. So it's definitely going to be a doozy. We're going to be around the 2,800 to 2,850 level at the open if things remain. And what we're looking at, if this plays out now this is just speculation, but we like to kind of anticipate the way the market's going. We've broken this trend line here, this accelerated trend line we had going. We've clearly broken below that, and now we're in our third week below that. So I think we're going to see some kind of price movement down to here before we get a bounce up to maybe the 50-week moving average, which usually matches the 200-day moving average. And then we might see lower depending on how the economy takes to the coronavirus and the oil crisis we're about to have. I will say, when the weather starts getting warmer, this might end up being like, the typical flu season where the flu kind of dies out as the weather gets warmer, and it might die out before we get to a point where we see this bigger leg down. So we are not trying to anticipate a crazy bear market right now, but we do think things are a little concerning. All right, so now that we know that the 2,700 level is the area to look for longs, I do want to mention that I think it is too late to go short here. I think with the volatility of the market, you could get burned. So we want to wait until we're at an extreme. And the time to go short was when we had our very first market commentary video back at this 3,300 to 3,400 level. We did indicate that the market was oversold and it might have been good for a short position. All right. Now that we're done talking about this weekly chart, I'm going to show you that longer term weekly chart. All right, we see this long-term primary trend here started back in 2009, March 6, 2009 at the 666 low in the S&P 500. We had our low in 2011. We had our low in 2015 and 16 and 2018. And let me just go back to that fear greed index. This was the low there. You can see we were at that extreme fear for actually a few months there. So that is something to note, and we could head straight down there. So we're looking at this 2,700 level, and that is our first primary trend level of support. Now that we've broken this accelerated trend line, we definitely want to pay attention to this level. I think a break below that level is going to be definitely a problem for the market overall. We can see our RSI has broken down from the overbought level, and we've actually just shot straight down below this kind of trend we've got going on here. Let me indicate that with a trend line here. But we had a trend going on here, and we've broken below that. And as you can see, the last few times that's happened, we've broken down to the primary trend line. So these are some things to pay attention to. We've also had our MACD bears crossover, and we're at an overbought, extreme overbought level. So again, we are not quite oversold on the weekly chart. So we want to be trading with the long-term trend. Right now, the long-term trend is telling us we are not quite oversold. So we should not be taking any long or short positions at this time unless you're day trading. We want to be waiting for these high probability entries. So somewhere around this primary trend is the next entry we're looking at. Okay, let's go ahead and take a look at the daily chart. We can see that this is where we left off Friday last week. And as I indicated earlier, the next best level is the 2700 level. We've got our little caution box here. I don't know if you can see that on the computer, but we're also not completely oversold on the daily chart. So we could see this next leg down straight to 2700. This is something to pay attention to this week. Hopefully that doesn't happen, and hopefully we're completely wrong and we have a bounce. But with the way the oil is going and the coronavirus, be prepared this week to see some blood in the market this week. And I'm definitely looking at this 2650, the 2700 range, maybe up to the 2750 range. I might consider taking a long position, but I definitely want to wait until we're close to that 2700 level. All right, now that I've talked your ear off, let's go ahead and look at an oil chart before we move on to some stocks that I think are, no, I wouldn't call them safe havens, but a little bit better for you long-term investors. So this is the last oil chart we had drawn. Now that we've got this Saudi Arabia oil deal going haywire, we're actually looking to open somewhere around here this week, which is pretty insane if you think about it. That's about a 50% drop from the previous high right here, where we did indicate a short position. However, we would have sold that short position somewhere around here if you pay attention to our swing trade strategy. All right. So we are not taking long positions oil just yet. We want to make sure we have a trend established, but we are in extremely oversold territory. We were actually considering a long position in the 38 to 40 level, but this was over the weekend when I had this up. So now I'm just going to go ahead and delete that because we want to see some kind of trend line or some kind of support before we move into that. Jake, I don't know if you want to add on oil right now, but it's looking pretty bad. So I would try and avoid oil while this whole oil price war is going on. Wouldn't you agree?
Yeah, I would agree. It's just there's no clear direction yet, and you don't want to be taking a position when you have no clear direction.
Exactly. Yeah. And so a few things that I wanted to bring up. So first, as you can see in my tabs, I've got all these different stocks pulled up. The first stock that would be considered a safe haven is VDC. It's Vanguard Consumer Staples ETF. There's also an index fund for this. I just don't know what the symbol is. If you're looking for some kind of safe haven to ride this stuff out, VDC is a consumer staples index, and it is one of the best performing in terms of bear market. So I'm going to go ahead and bring up a performance chart in comparison with SPY, which is S&P 500. So as I bring this up, we're going to look at the performance of that back in a bear market. So, all right, let's go here. So let's scroll back. Let's come back to 2018 here.
And
right.
Just to chime in, the mutual fund for the VCS.
Can you say that again? You cut out.
VCSAX.
VCSAX. Okay, VCSAX. Yeah. All right, so now let's come back to the peak of, close to the peak of 2007. And you can see red is Vanguard's consumer staples. It performed much better during the downturn, and it recovered quicker than the S&P 500. Now, this is obviously not going to mitigate all your losses, but this is a great way to remain in the market if you're a long-term investor, and maybe you're considering some kind of leaps. You can start buying leaps on this and roll those over. And you can see it just performed significantly better. The S&P dropped over 50%, whereas VDC dropped 25% at its max drawdown. Okay, so now that we've talked about VDC, I'm going to bring up a few individual stocks that are oversold that could be potential plays if you are considering if you're considering individual stocks and you don't want to trade an index fund. So we got McCormick's. These are all aristocrat stocks I bring up, by the way. These are blue chip stocks. So we got McCormick, We've got Altria Group. As you can see, it's been in kind of a long-term downtrend, but when things get dicey, let me pull up a long-term weekly chart actually. When things get dicey, that's not long enough still. Let me just pull up a monthly chart. How about that? All right, you can see back in 2009, the losses were definitely much less than the S&P 500. These are the types of stocks you want to be looking at. This might be something a little less ideal because it is a tobacco consumer staple. But when you're looking at something like a Cisco here, these are very oversold blue chip stocks that are well worth taking a look at in your long-term portfolios. Next, we've got Universal Corp. That's another tobacco one. I would honestly stay away from this in MO. I should have looked at those beforehand, but again, when you're looking at your long-term portfolio, you want to be looking at consumer staples. I think treasury bonds are too heated right now. Gold is too heated. So if you're looking for that safe haven, consumer staples, a lot of these are oversold because of that crazy week we have, and we're about to have a really aggressive open low if things hold. So let's go back and see where we are right now. All right, so yeah, we're still at 4.5%. We actually gone down a little bit more since last time we checked. So I've got 3 stocks here that are consumer staples, that are aristocrat stocks that have performed well over the years. We're going to go ahead and take a look at the monthly chart for each of these. So we've got McCormick here. This is a food product company. As you can see that in 2009, it did have a 30% decline, but that is much less than the S&P 500. And then next, we have Cisco. This is another food retailer. We're going to look at the monthly chart here. Again, same thing. We had this one was actually closer to 50%, but you can see the kind of performance you get out of consumer staples over the long term. These are very stable blue chip stocks, aristocrat stocks. That means they've consecutively increased their dividend for at least 25 years or more. And then last but not least, we have Walgreens. I was surprised to see this one on the list because of the coronavirus scares, but this may also be a play. This is a consumer staple. We've got a PE showing at 12. Great dividend yield. This is, again, another aristocrat where they've increased their dividend for 25 years plus. So these are some 3 different stocks you can look at for maybe the impending bear market we're having. We don't know. Again, markets in turmoil, right? But that kind of wraps up this weekly preview. I'm just going to go ahead and open up the S&P 500 weekly chart just so you can see that long-term chart. And again, we're looking at that 2,700 level. We do not know if we're going to get a bounce overnight. We do not know if maybe the Feds come in and they say they're going to pump money into the market. But as of right now, we're looking at this support level. And we don't think it's worth the risk shorting here. And we also would not be taking long positions unless you've started to scale into one. Okay, that wraps up this video. Jake, I don't know if you have any additional comments we can add.
I just saw in the New York Times about an hour ago, Australia plans to stimulate bad virus impact. So that's stimulus.
You cut out. Can you go ahead and say that one more time?
Yeah. Australia plans a $6.6 billion stimulus package to combat virus impact.
Okay.
So stimulus packages around the world might be.
Yeah, so that could definitely fuel the bounce that we're looking at around the 2,700 level. Now we may not get there. We may just get down to 2,800 before that happens. But this is the level where we think the lowest risk is if you're looking at making a long-term entry and we want to play the bounce. We think that BTFD is not exactly the play anymore, so be careful when you're doing that.
Yeah, no YOLOing.
Yeah. So I guess I'll pull up one last chart. This is kind of a bonus here. So ignore all the craziness going on here. I'm actually going to turn this into a 20-year monthly chart. Okay. So as we can see, we've broken down from this primary trend. Actually, I'm going to clean this chart up even more. We are going to pull this up here. Right here. Okay, here we go. So this is a clean monthly chart. We're looking at this from the perspective of our long-term primary trend. As you can see how many times we've kind of bounced off this over the years since the bottom of 2009. And so what we're looking at is this 2700 level. We don't know if that's going to happen exactly, but I think this is a safer play. And as you can see, every time we've broken down from the RSI, every time we've had a MACD bearish crossover, we've had some kind of downturn in the market. And it pre-indicated the financial crisis. It pre-indicated the tech bubble. So this is kind of a metric to look at for when we're gauging bear markets. And right now we just had that bearish crossover on the MACD on the monthly chart. So that is something to pay attention to. And I've got 2 points here indicated. If we do into a long-term bear market, this could take a few years, but we could see down to 2100, maybe even 15 to 1600. So just be prepared. Don't be the BTFD crowd that is buying every single dip, because you don't know what's going to happen. As we just saw that, we're looking at oil here. Oil's down 22% in one night. Those are things that you can't predict. And if you're the buy the dip crowd, you're going to get burned. So these are things to pay attention to. So that kind of wraps up the weekly preview. If you haven't heard, we have a Patreon where we go into detail about strategies, personal finance, where to invest your money, what type of accounts is the most tax efficient. You can find that at patreon.com/finsights. That's FINSIGHTS. And then again, we got our Facebook, Finsights by Justin Wilson on Facebook. And we post these videos regularly in Patreon, but tonight I thought it was a good night to go ahead and make a public video. And I hope you found some value out of this. Be careful this week. It's definitely looking like a bloodbath. So if you are a long-only trader, definitely be careful. Go ahead and end on markets in turmoil there. All right. All right. Have a good one. Hey, welcome to another episode of... Oh my God. Blooper reel.
Yeah.